Daniel, thanks very much for joining us. Would be good to get your sense of the outlook for 2022, both in terms of, I suppose, Europe, but also the French market.
Well, for the French market, two indicators, GDP and rates. In terms of GDP, France has had the deepest recession in 2020, -8%, and therefore the biggest surge in GDP in 2021, about 5 to 6%. Economics-wise, we believe the healthcare crisis has been quite well managed in terms of compensations for companies. And today we've got falling unemployment rates, and there never has been less defaults among companies and therefore tenants. So that's quite positive. And then there's the interest rates issue. And clearly, I think we need to come to the realization that France is actually a very defensive play, a very low default risk. And sometimes people are surprised by the fact that our rates are so low and quite close to Germany, for example, who has a reputation of being a better run country or state. But that's because there's structural political stability in France with an election where you need to have more than 50% to be elected. So that's quite a hedge, and that's quite a guarantee of some political stability. And also, we don't tend to brag about that, but an infrastructure of collecting taxes, which is quite efficient actually, and which differentiates France from southern countries which have a more difficulty to. We saw that with Greece, of course, but also with Portugal and Spain in the recent years, have more difficulty to collect taxes and therefore reimburse those who hold the French sovereign debt. So I would say that France in terms of risk is really a defensive play, and especially in today's context.
Looking forward to 2022, Daniel. I suppose, what are you seeing as the key trends there in terms of investment?
In terms of investment, I would say there's clearly two trends. One is a flight towards quality on the office market. So clearly there's a concentration of investors on prime because inner Paris, the inner ring of Paris, has actually a vacancy rate of about 3%. So clearly it's very low, and there's plenty of room for upside on rents. And of course, there's clearly investors are concerned about the quality and including the obsolescence risk and depreciation risk and tenant risk of secondary assets. So I see that there's going to be a flight to prime offices and prime Parisian offices, which are today at 2.75 in terms of cap rates. And then there's a second trend, which is a shift to some alternatives, and I would call them decorrelated alternatives, such as residential and logistics and healthcare real estate, of course. So in the case of logistics and healthcare, you've got some long lease assets decorrelated, which are very attractive in today's market because I think basically the investors have realized that offices were cyclical and that there were some risks, even external to financial risks, on the market, and that's the realization we are coming to, and that's the case for healthcare, for health, and that's the case for environment also. And then there's in these alternatives residential, which in my view is becoming less of an alternative and more a mainstream core investment, because we've got some investment volumes in residential from institutionals that are really surging on a European level and which have been multiplied by a factor of 5 on the French market, starting from 1 billion investment volume in residential from institutionals 3 years ago to 5 billion last year. So clearly we something is happening on the residential market.
Really great to get your insights on that. Thanks very much, Daniel.
Thanks for having me.